Helge, what exactly is a bond and how does it actually work?
We actively fight for your hard-earned money.
It's quite simple. A bond is a loan agreement between the issuer who issues the bond and the investor who buys the bond. Typically, these are either governments, municipalities, or companies that issue new bonds. And the company or the government needs the money to carry out projects. For example, right now, the German federal government is massively increasing its debt.
Yes.
When they do that, where do they get the money from? They issue new bonds.
So the whole project with the military that Europe is now discussing, they want a European army. If that goes through, it will be financed by bonds. Am I seeing this correctly?
It is financed exclusively through bonds. They issue bonds and someone has to buy them, namely an investor who thereby enters into a loan agreement. And the Federal Republic of Germany provides a guarantee for two things. First, a fixed interest payment every year.
Yes.
And second, the repayment of the principal at the end of the term.
Okay.
That is the guarantee that the company or the government provides. Of course, a guarantee is only as good as the guarantor who issues it, right? Yes, exactly. Because the fundamental point is this. If I possess a bond and the issuer unfortunately doesn't pay, then of course I absolutely want to get my invested money back and apply significant pressure on the issuer. But it's difficult to get your money from the German government.
Put pressure on them.
Of course, the German government is also a good issuer with a AAA rating. But in principle, we have a certain mistrust. We prefer companies.
Yes.
There I have a big advantage. Namely, if the money isn't paid on time, and this is regulated differently in every country.
Yes.
Usually that's 30 days here in Central Europe. In Northern Europe, it's just 1 day.
Yes.
Then bondholders can go and say, give me the keys. I now own the company. The shareholders are expropriated. As a bondholder, I then own the entire company.
You have the privilege, meaning you have a priority over the shareholder. So bondholders have priority over shareholder. First, it's the shareholder's turn. They have to pay first. And only then do the other bondholders, that is the investors in bonds, come into play. They only come after that. So first, the shareholders have to lose their money and only then the bondholders, right? That's why it's also much safer than stocks.
Yes, of course. And the advantage of bonds, of course, is that I can look into the future. It's the only asset class, at least as far as I know, where I actually know the future. Because the point is, if the issuer pays the interest and the principal back, then I know exactly how much I'm going to get.
Yes.
That means based on the price at issuance or the current price, the coupon rate and the maturity, I can calculate exactly how much I will receive.
Very nice. Thank you very much. What role do interest rates and maturities play in bond?
It's a very central factor in determining what kind of deal I'm entering into as an investor. The point here is, in my mind, I am the bank. I benefit when I receive interest payments over a longer period of time. That's what I want to do when interest rates are high. But if interest rates are low, then I definitely want to go for shorter maturities because I'm not getting much interest. If the interest rate level changes during the term, then this also has an impact on the price of the bond. Bonds are traded on the market, and this means that bonds react to changes in the interest rate level. Let me give an example. If you had bought a 30-year US government bond in August 2020 and sold it today, you would have lost 40% of your money. The bond has dropped from 100 to 60. Is that because people think the US government is going bankrupt? No, definitely not. The reason is that at the time in 2020, the bond had an interest rate of 1.2%. Today, it's almost 5%. That means that today, when the US government issues new debt securities, it has to pay 5% interest. But that means that the bond that has already been issued also has to rise to the same interest rate level. However, the coupon is fixed, and this adjustment happens through the market via the price of the bond. So in this case, someone who bought long-term US bonds in 2020, and it's the same in Germany, has lost about 40% of their money if they were to sell today. Interestingly, banks that also held bonds do not have to write this down in their balance sheets. A completely absurd situation, because they can simply record it in their balance sheets at the same price they bought it for. The principle of commercial prudence does not apply here. This way, the state is able to offload more bonds. But the point is, as a private investor, as an investor, I really have to think carefully. How are maturities changing? How are interest rates changing? And which maturity should I choose accordingly?
So, do you typically tend to go for long-term, short-term, or perhaps even medium-term bonds? Because I genuinely think there's a very significant market for short-term bonds, that many people really like to actively buy short-term bonds, whereas they are not as strongly motivated to purchase long-term bonds.
Yes, the right answer here is it depends. The point is, you have to assess that short-term bonds, I mean bonds with maturities of 3 to 5 years, so short to medium term, have the advantage that the interest rate risk is practically eliminated. Because if I hold on until maturity, I get my money back. The fact that the interest rate level changed in the meantime doesn't matter. Because if I bought the bond at the issue price of 100 and I get 100 back at maturity, and I've received my interest payments, then it really doesn't matter whether the interest rate level changed. But in certain situations, it can also be quite attractive to lock in the interest rate level for a longer period of time. Let me give you an example. At the end of the financial crisis, the market was very nervous. And as a result, companies had to offer very high interest rates to the market in order to issue bonds. And back then, there were 2 bonds that we also bought for clients. One of them was a bond from Daimler. It had a coupon rate of 9% and a maturity of 2 years. We thought, wow, this is really a good deal. And they were also senior secured. And we bought the bond back then as well. For 2 years, we received 9%, and 9% at the same time. There was a second bond that we also bought. That one was from John Deere, the big tractor manufacturer. And it had a bond with a 10-year maturity and an 8.5% coupon, a little less. So we thought, okay, both deals were reasonably good. But the point was, they paid 8.5% for 2 years. After 2 years, both companies were able to refinance at 1 to 2%. The worries from the financial crisis had faded away. The market was open again. The Daimler bond had matured and Daimler issued new bonds with a 1 to 2% coupon. John Deere did the same. They issued bonds with a 1 to 2% coupon. But this bond was still on the market and couldn't be redeemed early, and its price was at 160. And accordingly, that was a very important learning experience for us. In the end, we made a major mistake and succumbed to the temptation to buy Daimler at 9% for 2 years. The right move would have been to focus much more on the John Deere bonds that were available at the time and to lock in the interest rates for the long term. Because anyone who invested in the Daimler bond received 18%. Anyone who invested in the John Deere bond received 17% plus a 60% price gain. Accordingly, when interest rates are high, you have to lock in those rates for the long term. It's very important to keep this mechanism in mind.
Very truly nice. So, if you're interested in a bond and want to know more about bonds, and if you're considering adding bonds to your portfolio as a diversification, then give us a call. I am happy to arrange a meeting with Helge Müller for you and to review your portfolio and study how we can add bonds online. This can be especially interesting and highly relevant for older generations, particularly for those individuals who currently live abroad and receive their pensions, meaning those who significantly rely on regular financial payout. With bonds, it's not like with stocks. With bonds, you already know in advance what you're going to get. The only thing is you have to choose the right issue. And that's where Helge is, of course, a top guy because he actually goes into the companies. He visits the issuers face to face, goes into the company, looks at the balance sheets, talks to the right people, and selects issuers where no mistakes are made. That's why I have also invested part of my private assets with Genève Invest. That's the name of Helga Mueller's company. And I have to say, I am very satisfied with it. Thank you very much. Goodbye and see you on our YouTube channel.